Hello and welcome back to the Naked Expat channel. What if I told you there was an investment with guaranteed returns and those returns were known from outset? The investment had absolutely no stock market risk whatsoever. It was free from inheritance tax. And also HMRC, the taxman, can't get his hands on the money at all. You would be thinking, that sounds too good to be true, right? Well, it's not, so be prepared to be enlightened. Firstly, you need to understand what happens to your assets on your demise. Now, this is important. Please do bear with me because this applies to people that are considering becoming an expat, those that are expats already, or simply middle and high income earners, high net worth clients that are concerned about the movement of their assets upon their demise. This is really, really important for everybody, so do bear with me. And at the end, I'll be providing some fantastic tips for future expats and also landlords. Very, very important, so do bear with me, please. Firstly, as you may or may not be aware, when you die, you have in the UK what's known as a nil rate band allowance, which is currently £325,000. If your assets and your net worth is higher than 325,000, then you have inheritance tax to pay on the remainder. Now, just bear with me because this is important. Even more so with the rise in UK house prices. Now, let's take an expat, for example. It's got an estate worth, say, £500,000. Okay, so they've got £500,000, and of that, there's maybe a house and some assets. Say the house is worth 300,000 and assets of say 200,000. So total net worth is £500,000. Now, because they're an expat, there's no residential relief on the main residence because they don't live there. They're an expat. So there is no main residence property relief. So the nil rate band allowance of 325,000 is like the only discount that's available to this person. So if your net worth is 500,000, irrespective of how that's made up, then you can take off of that 325,000, which is your nil rate band allowance, nil rate band, which means you have a liability to HMRC of £175,000, okay? Now, inheritance tax is currently at 40%. So you have to pay HMRC £75,000 inheritance tax. Now, this is what's very, very important and most people do not understand this. HMRC are the big boys. When you die, your estate will go into probate in most instances if you're a higher net worth individual. For very small estates, that obligation is usually waived. But if you have an inheritance tax liability and your estate falls into probate, the taxman's got to be paid before that money is released. Now, this is important because where's the money coming from to pay that 75,000? A lot of people are under the misconception that, well, this person dies worth 500,000. So once I sell all their assets, I can pay the bill of 75,000. Nope, it doesn't work that way. Before the estate can be released out of probate, that bill needs to be paid. And this is where the banks come in, because the banks will know when they look at the estate, oh, there's plenty of money there. So we'll give you bridging finance at an extortionate rate. And therefore we'll lend you 75,000, like a very, very expensive short-term mortgage, so that you can pay the bill. And that's where they make a lot of money. Well, why give your beneficiaries such a headache when it can be avoided from outset? And this is what you can do in order to do that. Now, when I say two words to you, life assurance. If you're British, the general mentality is, how much is that going to cost me? If you're American, for example, the general mentality is, well, how much have you got? It's almost like bragging rights. In the US, it's like, how much cover have you got? It's almost like if you're more insurable, you are a higher net worth individual, therefore you're able to get more cover. So it's like bragging rights around the dinner table. I've got $2 million US worth of cover. Well, I've got $3 million worth of US cover. It's a totally different attitude. In the UK, it's very much seen as an expense you can do without. That's because with life assurance that's, say, associated with a mortgage, for example, as most people think, well, it only pays out if you die, and it's for a certain period of time. Well, that's term assurance. I'm not going to be talking about term assurance here, so it's very, very different, and it's why it's extremely interesting for everybody. Let's take my previous example where somebody's estate is worth 500,000. And if you remember, they had a nil rate band of 325,000 as an allowance. So they had 175,000 tax liability on the rest. Well, I'm going to give an example of £180,000 worth of life cover, and there's a reason for that, because I've got a fantastic story to tell you. If your estate's worth 500,000 and you've got a nil rate band of 325, you've got tax to pay on 175. The last thing you want to do is have a life assurance policy of 180,000 coming in, 180k, because then instead of starting off at 500,000, you're starting off at 680,000 before you get your nil rate band of 325. Okay? Big problem, because you've got 375,000 tax liability at 40% then, which equals £142,000 tax bill. Not very good for you, very, very good for the tax man who's going to be HMRC is going to be rubbing their hands together in glee, because you've got £180,000 life cover, which has just made your estate even more pregnant with gains. So great for them, not very good for you. So what do you do about that? Well, what you can do is this. Excuse the board. You've got a £500,000 value of your estate, and you've got a nil rate band of 325, which you don't have to pay on. So you got a bill of 175k at 40%, which is 70,000. Now what you do is you have £180,000 worth of life cover, which is written into trust. So when you die, the 180k is paid into a trust. It doesn't form part of your estate. It's separate. And key thing is, because it's in trust and it's life assurance, you have no material benefit from it. It's only worth anything when you die. Until you die, it's just a piece of paper. When you die, it's worth 180,000. So you've gifted nothing whilst you're alive. The 180,000 goes into trust, and the trustees pay it out. And within that trust, you've already nominated maybe your children or your grandchildren or your spouse, usually children and grandchildren, as the beneficiaries. And then they can spend the money however they want. And because it's outside of probate, they can use some of this money to pay that bill. Now, because it's in trust and it avoids probate, that 180,000 that's paid by the insurance company is normally paid out in about 4 or 5 weeks. Very short period of time. 180,000, plenty of cash in order to pay your inheritance tax bill without exaggerating the value of your estate. How can you do this? Well, if you gift money outside of your estate, normally it's subject to lifetime allowances and certain caveats. The key thing about life assurance premiums in this instance is, one, it's a whole of life policy, which means the £180,000 life assurance is going to pay out because the policy runs for the whole of your life. Now, if you fund the premiums, there's 2 important things that you need to remember. One, the premiums, the amount that you pay has to be regular. So most people pay regular monthly premiums. It needs to be gifts, ordinarily out of income, not capital. So you need to have a regular income in order to cover the premiums or pension, etc. And whatever you do, when you pay the premiums, it shouldn't limit your standard of living. So you need to maintain the same quality of standard of living and not bleed yourself dry in order to get money outside of your estate. Because what's happened in the past is people have taken out very large life assurance policies in their latter years, and they've lived on the breadline in order to fund all of the premiums. And that's not going to wash with the tax man, because they're going to basically say, actually, hang on a minute, you cannot maintain your standard of living. All you're simply doing is moving cash outside of your estate in order to lower your inheritance tax liability. You can't do that. So those two specific things are like a catch-all. You have to be able to maintain your standard of living, and they have to be gift ordinarily out of income. If you can satisfy those two requirements, you're good to go. And in most instances, you can. Now, I'll explain a bit more. The reason I gave an example of £180,000 worth of life cover is because this is a true example of a client of mine, a lady that I managed her investments for about 8 or 9 years. And she called me up and said that she'd like to invest a little bit more on a regular basis. Now, this lady lived in Pilton near Glastonbury, very close to Michael Eavis and the Glastonbury Festival. And she got this beautiful farmhouse, like large country cottage, almost farmhouse. And she was worth quite a lot of money. And her estate was, if my memory recalls correctly, about £600,000 or £700,000. And this was back when I was advising her in the early noughties. Now, she wanted to invest on a regular basis. She's 72 years old. And I said to her name was Eleanor. I said to her, well, Eleanor, why are you investing? You're just investing for the sake of investing. You don't need the money. Her late husband, she was a widow, her late husband had done a lot of financial planning previously. There was no mortgage. Obviously, she's 72 years old, living in a lovely country cottage, plenty of capital, and also a regular income and a widow's pension. Her income was about £25,000 a year. She didn't need it. So we did every year, we did like what previously it was personal equity plans, PEPs, and they were superseded by ISAs, individual savings accounts. And she'd maxed out on those. She's just investing for the sake of investing. And she wanted like medium risk as such. Now, I said to her, well, why are you investing? You're 72 years old. What are you looking to achieve? You don't need to make any more money. Both of her children, one was in a medical profession in London and earning quite a good salary. Her other son was in New York in finance and earning a considerable amount of money. They didn't need any money, but she'd always promised her late husband that she would take care of her finances, and on her demise, she'd make sure that the grandchildren and the great-grandchildren were taken care of. So that's why she was an active investor, and she was very, very shrewd. She's 72 years of age. And so I'm scratching my head thinking, well, what's the best thing to do here? You don't need any more money, and all we're going to do is make you're worth £600,000, £700,000 already, and just by making more money, and we've done very, very well out of our existing investments, we're just going to swell the value of your estate, and the tax man's going to be taking 40% of it. So that isn't very good. Now, what we did, she was 72 years of age, and we took out a whole of life policy for £180,000. The figures just worked out great for her in this respect. And it was a whole of life policy which runs the whole of her life. And she's 72 years old. Now, the premiums for that, the premium was £450 per month. Okay? Or £5,400 per annum is the premium for the cover of the life assurance of £180,000. She's 72 years old, remember. Now, before you think, whoa, hang on a minute, I'm not spending £5,400 an annum on premiums, but just hang on, because it's a lot better than what you think. Now, Eleanor lived for another 7 years, okay, until she was 79. And then, rather unexpectedly, she passed away at the age of 79. And the first I knew about it is when her son from America came over and spoke with me and wanted to go through all of her finances. Now, during that 7 years, she'd paid £37,800, okay, total in premiums. But you can see where I'm going with this. Very good investment, right? Because she invested 37, not cost. This is where you need to change your mindset. The cost of this life assurance wasn't 37,800. It's an investment in the life assurance. It was 37,800 because surprise, surprise, we turned in 7 years, that 37,800, it paid out the sum assured, which was 180,000. And on top of that, that 180,000 was written into trust. So it didn't form part of her estate. There's her house. Excuse my, I was never very good at art. That's her estate. The 180,000 didn't drop into her estate, which was worth about 800,000 already. It avoided inheritance tax altogether because the 800,000 was written into trust for the benefit of her children and grandchildren. Bear in mind the children were quite wealthy anyway, and that 180,000 they used to pay off the inheritance tax bill that they needed. Now the wealthy son was able to top up the 180,000 in order to pay the rest of the probate. But he was amazed when he came over and he visited me in Hargreaves Lansdowne, where I was based, in Bristol. He said, Andrew, this is absolutely fantastic because I've got 180k that him and his brother had agreed that it was split between them. They'd used 180,000 in order to cover the vast majority of the inheritance tax bill. Bearing in mind the inheritance tax bill was, her nil rate band was 325 and her estate was 800,000. Oops. Now they used 180,000 in order to cover the bill on 475,000 estate, which was the 800,000 total net assets less the 325 nil rate band. So that 180,000 came in extremely handy. The one thing to bear in mind in my example with Eleanor is that although her husband's estate planning was very, very good and he was financially very astute, what he didn't do was anything with regards to will planning with his estate, because here he was, Mr. and there she was, Mrs. Now, in their joint will that they had, rather than individual wills, he left everything to his wife on his demise. Everything. And between husband and wives, or civil partnerships now, there was no inheritance tax. So IHT is 0. There's no inheritance tax. Inheritance tax only became due when she died. But he died without using his 325 nil rate band. And when she died, it was only one nil rate band of 325k that was available. Had they done individual wills, then when Mr. died, he could have left 325 in trust to his children or grandchildren and passed the remainder to his wife inheritance tax free. And then when she died, she'd have her 325. They would have both used their nil rate band allowance, but they didn't. And this is where, well, what's this got to do with being an expat? This is very important about being an expat, because if you are husband and wife, or you are civil partners in the UK, and you're both British citizens, you are both entitled individually to £325,000 nil rate band allowance before there's any inheritance tax liability. You're both entitled to that. But if you're ahead of me here, you can guess what happens. That's only if you're British citizens. Now, if you're an expat married to, say, your wife is European, American, Australian, Philippines, Thailand, they're not entitled to that. Only you are, as a British citizen, expat. So you've only got 325,000 to deal with. Now, here's a kicker. There's been a recent change to inheritance tax legislation, which is really important for all expats to understand. If you are, say, I'll give an example. If you are a British expat married to, say, a Filipino, your nil rate band is 325,000. Now, let's say you've got a property in the UK and it's worth, say, 400,000, and you rent it out. Now, if your property is worth 300,000, 350, it's almost irrelevant. Let's say you're worth, in fact, I'll make it easy for you. Let's say you've got a property worth 300,000 in the UK and you're retired. You're living in the Philippines, you're enjoying your retirement. You've got a property for 300,000 in the UK and it's rented out. Fantastic. Good thing you can do, because you can't own land in the Philippines or Thailand, places like that. And maybe you were recently married to your Filipino wife, so you never know, 7-year itch and everything else. You got a banker here, you got £300,000, you got a house in the UK, okay? There's your little house in the UK. And it's rented out. Great, makes a lot of sense. You've got a capital accumulation as it increases in value, like property generally does in the UK, and you've got a passive income from the rental income. £300,000 asset. When you die, let's just say you're in your mid-60s and you die when you're in your late 70s or 80s. Chances are that property's gone up in value. Now, it doesn't really matter, for the sake of this example, the nil rate band, we know, is 325,000. And we haven't got a clue whether or not that's going to go up, or it's probably not going to go down. We don't know how much that's going to go up in the future. But let's say it's 325,000. This house is going to go up in value, yeah? So, let's say you die and the house is worth 400,000. And let's say when you die, the nil rate band is 350,000, okay? So you've got inheritance tax to pay on the difference, because your nil rate band's 350, the house is worth 400 when it gets sold. Now, if your wife was British, no inheritance tax to pay, because assets will go from husband to wife. Generally, the girls outlive the boys. So you can see a problem here. You've got a house worth 400,000. It's worth more than the nil rate band. The nil rate band hasn't crept up as much as the value of property. Surprise, surprise, that's realistic that that's going to happen. So you're 50,000 over the top, and that's payable at 40%. Okay, and that's a bill that your foreign spouse has to pay before the estate is released. If you were both British citizens, no inheritance tax to pay. However, there's been a recent change to inheritance tax law, which is extremely important for everybody to really appreciate. I've done a vlog on this previously, but just to cover it, essentially, inheritance tax used to be paid on your worldwide assets, 100%. So let's say you are a British expat, and it doesn't matter if you're Mr. and Mrs. or Mr. or Mrs. or civil partners. Inheritance tax used to be paid on your worldwide assets. So whatever you're worth, everything, all your property, all your investments, everything, whatever your total net worth is in your existence throughout the world is subject to, that forms part of your estate and is subject to inheritance tax above the nil rate band threshold of 325,000 on your worldwide assets, your global assets. Now, a recent change to legislation is extremely important, because what's happened in the past is high net worth clients have had lots of complicated trusts set up so that they move assets outside of, this is global, but they move assets outside of the UK into all of these trusts in order to lower the value of what's payable for inheritance tax in the UK. It's all going into trusts rather than being part of your assets in the UK. Extremely messy. Legal, if it's done properly, it's called tax mitigation, not tax avoidance. However, extremely complicated and extremely expensive to do. The recent change in legislation for inheritance tax means that you are only assessed on your UK assets. So this is what's really important for potential UK expats who are going to move abroad and UK expats that are currently living abroad. Because now what happens is, let's say, for example, you've got assets of 325,000 in the UK and you've got other assets of, say, 400,000. You move those assets offshore. So that they're outside of anything to do with inheritance tax. You only keep assets in the UK up to the nil rate band value, which is currently 325,000. So, as I said before previously, this is very important for, say, landlords. If you've got a house worth 500,000 and you're an expat, that's not your main residence, it's rented out. So there's no residential relief or anything like that for inheritance tax. That 500,000, when you die, is over and above the nil rate band, and you're going to get hit with inheritance tax, yeah? On 175k. And we already know what that is at 40%, don't we? Why bother? Because all your other assets outside of the UK are not liable to UK inheritance tax anymore. So keep the vast majority of your money offshore. Depending on where you live, you can buy other properties in Europe, Asia, for example, condominiums or whatever you wish, but outside of the UK. All of your assets outside of the UK are not subject to UK inheritance tax anymore. Only assets that are in the UK are subject to UK inheritance tax. This is really important because if you've got a property worth, when you become an expat, that property might have only been worth 400,000. That's quite common nowadays. But if you're living in, say, Thailand or Europe or Philippines, and it's gradually creeping up in value, let's say the market value is 500,000. You can pretty much bet your bottom dollar that the nil rate band hasn't gone up by as much. No way, because the nil rate band only creeps up a little bit and there's the value of your house going up like this. So it becomes more and more of a problem. Why not sell that house? You're enjoying the passive income from it, but don't get emotionally tied to it. At the end of the day, it's just a pile of bricks and mortar. Sell that house and buy one worth 300,000, which is lower than the nil rate band, and rent it out, yeah? You'll still get an income from rent, yeah? You're still a landlord, you're renting it out, you've sold that £500,000 house, use part of the money to buy a house worth 300,000 to rent out. You're still enjoying passive income. Oh. And surprise, surprise, you don't need to be a scientist to realise you take the 200,000 that you've realised and liquidated as capital from the property and stick it offshore. It's not liable to UK inheritance tax. So you've still got an asset, you've still got a passive income. Okay, the income is slightly less than the income from a £500,000 house rented out is probably less than 300,000, but you've got less headache and you're an expat, you're living abroad, so it's less of a liability as well because the house is worth less. Maybe it's less maintenance. Or you could have two houses of 150,000 each, even less of a headache, you know, and probably more likely to be able to be rented out, depending on the quality of the tenant, of course. And the 200,000 is offshore. It can be growing tax-free. It's not liable to UK capital gains tax. It can be invested offshore in like Hong Kong, Belize, Isle of Man. Generally, I'd stick with a highly regulated environment like Hong Kong or the Isle of Man. You know, and people like HSBC International are your friends, guys. Offshore investment platforms, these are your friends. You can invest that in a load of ETFs, which just track the market. Don't invest in managed funds, because at the end of the day, 99 out of 100 fund managers underperform the market. Go into tracker funds. They cost you absolutely virtually nothing with the likes of, say, Vanguard, for example. You can have a load of Vanguard ETFs for about 0.2% annual management charge. No commission on the way in, no charges on the way out. 0.2% is virtually nothing. You're getting the investments for bugger all, you know. Absolute no-brainer. And the other key thing is fully liquid. You try selling the property really quickly if you're living in Asia and your house is in the UK. It's a nightmare. So this is liquid as well. So you've still got rental income from the property that you have got, but you're downsizing your risk and you're increasing your liquidity. Absolute no-brainer. Now, I did promise you something with regards to if you're a landlord. There we go, we're nearing the end of the video now. This is absolutely key. If you're a landlord or potentially a landlord, always keep your assets in the UK below the nil rate band of 325 and keep all the rest of your assets offshore somewhere else. Very, very tax efficient, and virtually all expats need to consider this now. The other thing is with regards to what I was talking about with life assurance, a whole of life policy. Now, if you leave it too late, one, your health might deteriorate, which means nobody's going to insure you for a whole of life policy because your chances are you're going to die. So it's not worth the underwriters taking the risk. And two, life assurance in the UK, the market, like in America, is extremely competitive. Therefore, and the insurance companies have got excellent payout records. You've only got to mention companies like Legal & General, Prudential, Aviva, London and Victoria. These are blue chip companies with a 99%, 99.5% payout record or whatever. So you die, they pay out. And of course, if it's written into trust, it's paid out to your beneficiaries directly and it avoids probate. Now, the key difference is if you're an expat already, it's very hard, if not impossible, to get life assurance from a UK company because they deal with UK citizens living in the UK. So this is why, if you are in good health already, and it's something that interests you, you need to take out a whole of life policy written into trust for the benefit of your beneficiaries whilst you're in good health and before you become an expat. Because once you're abroad, you'll be dealing with international life assurance companies. And believe you me, they are much more expensive. So if you are considering something like this, you need to be proactive about it. One, before your health fails, and two, trust me, life assurance companies in the UK are fantastic. Their underwriters are very, very good, and the costs are considerably less than offshore. So do consider it. If you don't know a financial advisor that's competent in estate planning and inheritance tax, and you'd rather deal with somebody else, do get in contact with me. My email address is in the description box below, and I'll put you in contact with somebody with decades of experience, either internationally if you are an expat already, or if you're in the UK that's registered with the financial authority in the UK and they know their stuff. Whole of life policies are generally available up to £5 million guaranteed sum assured for people up until the age of 70. From like 70 to 75, that reduces to a maximum sum assured of about 2 million, and over the age of 80, about 1 million. And whole of life policies can be done on two bases. They can be done on a joint life first death, joint life second death. And some people say, well, how can you die twice? So that one is generally referred to as joint life last survivor. The premiums are cheaper because if you have a whole of life policy just on yourself, on one person, then as soon as you die, it pays out. Whereas if you have a joint life policy, it means that, say, your husband and wife, and the girls generally outlive the boys, although not in my instance. Both my parents were of good health, but my mother passed away about a year before my father, so it can be different. However, whole of life policy, joint life last survivor, or joint life second death, is the cheapest because when the first spouse dies, nothing happens, because it only pays out on the second to die. And you probably want that anyway, because usually what would happen on first life, maybe some of the monies would be inherited by the remaining spouse, which you don't want because you don't want the estate getting any bigger. So it is more common to have joint life last survivor. It's the cheapest for premiums. And then once the remaining spouse passes away, the monies fall into the trust and can be distributed as per your wishes in the trust. And you have full say as to who benefits from it, what percentage they get, when they get it, etc. So it's extremely flexible. So do consider this type of financial planning for expats, and especially if you're thinking about becoming an expat, do consider this type of financial planning, especially if you're considering becoming an expat. So I said at the beginning, this is extremely beneficial as a tax planning and estate planning measure before you move abroad. get underwritten, get accepted, get the policy on board, written into trust. You continue to pay the premiums. Doesn't matter then if you subsequently become an expat and move abroad. It's being proactive, not reactive. Once you've moved abroad, it's far more difficult and more expensive with international life assurance providers to do this type of cover. I know this is quite a technical subject, and yes, there are a lot of caveats that may or may not make this type of estate planning the right or wrong thing to do for your own personal circumstances. Everybody is slightly different, but I hope that you appreciate that what I'm trying to do is make people aware of this type of arrangement, which is extremely beneficial, not just for expats, but for people considering inheritance tax and estate planning in general, if they're in the UK. I hope you found this of interest. Do feel free to drop me a line. My email is in the description box below. I can put you in contact with a fully qualified estate planner in the UK, or alternatively, an estate planner, fully qualified and will writer that's used to international clients that's based globally and I've known for 20 years. Thank you.